course, a couple of people watching. Throw me a comment if you're hearing them all right. Oh, perfect. Thank you. Upcoming earnings of Microsoft 2024. Let's go. Thank you so much, guys. Let's see what we can do. Get some financial data up and take a look. Take a look at Microsoft. I thought we might build thought we might just go ahead and build a discounted cash flow model. All right, how's everybody today? Microsoft's earnings coming up. I think their annual report is coming up. I think their fiscal year ends in July. Let's take a look. All right. So let's go ahead and start. Let's start talking about Microsoft. Let me share the screen. That should work. You guys can see the screen all right. Drop this down, and I'll put Claude down lower right. Let's see if we can't. Drop that. Oh, that's better. Revenue forecasts. T out 5 years. Audio suddenly low. Okay. Sorry, I must have tweaked that. That's got to be better. It was doubling in my head. Let me see if I can play with some things on my end. Sorry, guys. I'm still getting used to this. All right, let's go get some financials, shall we? Income. Let's get the decade's worth of financials. Just going to pull down a couple income statements, balance sheet. And cash flow. While Claude's over here working on our expectations of revenue. You guys can see that. All right, good. Excel, cash flow. Got it. Okay. Consensus revenue 2026 current 230 billion. Next year 230 billion, 380, 450, and then maybe 670 billion of revenue in 2031. All right, so that'll give us kind of a benchmark. What about CapEx? Let Claude do its thing. Let's pull up the old discounted cash flow Excel sheet. This thing is an old but goodie. Simple one pager. This is actually the classic version, not even the one pager. This is the OG version. Wow. Let's take a look. When is Microsoft's financials? Pull down. Give me 1 second. Let's open up the Excel sheets we just downloaded. Hey guys, thanks for joining. Yeah, I've been all right. I took some time off, dealing with some health issues and feeling better. Thought I'd stream tonight. Oh, screen share again. I'm just pulling up all the financial and getting them up and running. So end of year is June. So we've completed. They'll probably get the next year, this current year, out in August. Usually takes them about 3 months or so. All right, that should be it. Let's see, go back to share. Now what I like to do is just take some of this information and put it into the one sheet that I had before. Let's see, 10-year, just move the whole thing in there. All right, and this is what? This is our cash flow. All right, next we got the income statement. We'll move this one in there as well. I'm just kind of preparing the data. I want to get it in one place. Right now I've got 4 Excel sheets open. It's just kind of a bother. So we'll just move this all over. Okay. All right, now let's see what we can do. Income statement. This is decades worth of income statement for Microsoft. Let's take it and we're just going to rearrange it so I can drop it into the forecast a bit better. So this starts in 2016, June, it goes to 2025. So we want our ending to be 2025. There we go. And what I'll do is I'll just link this up. So we've got revenue like that. There we go. Revenue's pumped in. We got 900 billion in 2017, and that has grown, God, every year to a $250 billion in 2025. VSAT. Yeah, sure. Depends how this goes. So let's see how growth rate looks. Why does it say NA? Count. That doesn't make much sense. Interesting. Let's go get EBITDA and we'll deal with this in a second. Thanks. Give me 1 second, guys. All right, sorry about that. Let's go get the EBITDA. So it's a little bit to set up, but once you get it, it gets you a good picture. And this is kind of a full version of how you can go build these. It's not too terrible. and I'm sure people can link it up to make it all automated. I can get it most all the way. The problem is always just it's always the cash flow. How do you determine cash flow? What is debt? That's always kind of a pain. What I'm not seeing is there it is, all the way at the end. Let's look at long-term debt. It's the balance sheet. We'll do the same thing. We'll just reorder this to be over this format. Let's go to debt. Here's your long-term debt. Actually, they probably stick it. Here you go. Total debt, cash. Good. Long-term push short-term. Total debt and excess cash, short-term cash. That's a lot of cash, man. Wow. Market cap we'll do in a second. Let's get the cash flow statement, and we're almost done. And we'll get pricing data, and we can take a look at what we have and start building a forecast. Forecast model. Stream is lagging, by the way. Interesting. I might. If I need a stronger computer, I'm just running this off my laptop. It might not be strong enough. Cash flow operations. Here's your CapEx. That's the biggest one everyone's concerned about right now. Just short-term debt payments. Sometimes you have to multiply all this stuff by 1 to get it to register as a numerical value. So I'm just going to do that now. I know watching me do this is probably not the most stimulating thing, but I figured I might as well throw it on, answer some questions, and then we can sit back and talk about a model. There we go. Oh, that's why the IRR wasn't working earlier, because it wasn't registering as a number. Now we got that. Some debts, fine. This is just summon that. All right, free cash flow, shares. We want the fully diluted shares. That's usually on the income statement. Weighted average, fully diluted. I don't need pricing information. Let's go over to, I think this still works, Yahoo Finance. Just signing in. Give me a second. Is the stream still lagging? Microsoft. Oh, not anymore. Good. Let's see. Historical data. So we used to be able to just pull, here we go, pricing information. I want monthly price, and I want, just take the max pricing data. But I don't want dividend. I just want prices only. Dividend. Let's throw in the dividend here. date here. That there. We want the, oh, that's end of month. Sorry, wrong column. Date, share price. I'll just take the closing price. And then copy the end of month formula all the way down. There you go. So now we have pricing data all the way through to July of this year. And up here, we've organized it by year. We just pull the ending price. So now go back to our financial model. We want the price per share. I want the ending price in 2027. So 27, $85. And there, and now all the stuff is populated. So we're ready to rock. You guys see that all right? I'll zoom in. That's probably much better. All right, so let's take a look at the income statement. Revenue growing 13% annually. Our forecast here in Claude was saying for revenue, where did it go? Where did it go? Where did it go? There. 3031, 672 billion. That is one hell of a forecast. That's crazy. Okay. If I grow, it says 3031 is here. This is EBITDA, not revenue. Okay, we'll get, do they have a revenue forecast? Growth rate. Well, there's your growth rate, about 15% a year over time. What's the current EBITDA? Wow, 129 million. If I just said, again, 15%, stretch that out, you get roughly the same, just assuming margins don't change. You just grow revenue with EBITDA. You're looking at, wow, $500 billion in earnings by 2035. Okay, what kind of multiple do we will put on this business? Again, earnings, just to recap what we did here, look at revenue is growing at 13% annually. So 15% in earnings might be a little strong, but earnings have been growing at 19% historically. So I'm not sure what the difference would be. Margins are definitely increasing. Does that still work? That's better. So I got 19% EBITDA growth over the same time frame, 13% on revenue. So margins are growing. You can see that here. This is growth rate, not margin. Let's do margin just so we can see it. Here's your margin. It's grown from 36% to 50% profit. I mean, you can't expect that to continue going up. That seems, I never would have pegged that. If you told me that they'd have 50% margin historically, I don't think I'd believe in it, would believe anybody. It's astounding. So let's keep the growth rate of EBITDA less than 19, less than the historical number. Which we're doing 15%. At 15%, you get to $500 billion of earnings in 2035. If I'd applied, a 20x multiple on this earnings, oh God, you get a $10 trillion company. And that's $1,400 a share. So here, if we just used EBITDA weighting only, all right, so that's this one. What's the current share price? Well, my computer's really lagging, guys. I'm sorry. I'm gonna have to look into that. Current share price, 389. Let's check the cash flow next. Cash flow forecast. Cash flow from operations growing at 17% annually, 118 billion of cash flow. I'll talk to you about the AI and laying off people in a second. I think this is a very interesting comment. 17% growth rate in cash flow from operations. That's matching the EBITDA. Great job, accounting team. Like, you know, you're treating cash and expenses properly. Let's see, that's kind of passes the smell test. CapEx here, they only spent 44 billion last year. Let's look what the CapEx forecast might be. So I asked Claude to kind of pull down what CapEx forecast looks like on Wall Street. So CapEx is a story right now, moving faster than revenue. Okay, here's a picture. Microsoft reported earnings on June. The company's increased framing's guidance for the calendar year. So calendar guided 190 billion. No way. Oh, 190 billion. So they made 118 billion in cash flow. They're going to spend 190 billion in this calendar year. That's more cash than they generate. I don't think I've seen them go cash negative like that. I don't know, 20 years more. Wow. Is that real? Calendar guidance, 190 billion. Year-over-year growth rate 61%. So if that's not right. So if I take what they spent last year times 161%, 161, that's only 71 billion. Something's not adding up here. 27 guidance, they haven't yet. Let's go to Finbox. Sometimes they have guidance on cash flow. Cash flow statement. Let's go to forecast. Yeah, I think that is crazy. Let's just smell check just to see if it's not that. Here's CapEx. So 2026 is the year. That's 116 billion. There you go. 180 billion in 2027, 190 billion in 2028, 200 billion in 2029 is the CapEx forecast. The range high, this is out 3 years, 326 versus one. So there's a huge disparity between the high and the low range. The low is ridiculously low. Well, maybe it's not that actually low. 90 billion. They spent 40. Yeah, Google, Tesla went negative. Yeah, you're correct. If we do, let's just look at quarterly instead of annual numbers here, and we can probably see the impact. I don't need 3 years. Let's just do recent. So last Q, it's tough to see. I apologize. I describe it to you. So very last quarter in March 31st for Microsoft, cash flow operations 46 billion, CapEx 30 billion. So they still spent less than operating cash flow. Operating cash flow 46 billion, CapEx 30 billion. Quarter before that 35 versus 30, quarter before that 45 versus 19. Quarter before that 42 versus 17. So it's the delta is definitely shrinking as it goes out, just getting closer and closer. But they can't spend everything they make because they pay a dividend. They're paying 6.7 billion in dividends. So they can't spend, well, I take that back. They can borrow money, but they haven't borrowed money in a long time. It's really tough to believe they spend all of that money. Let's go back to our forecast and and check in and see what we think. So let's go back to the forecast. We can run a couple different scenarios on CapEx. So CapEx. This is right now what happens with CapEx is you've got 118 billion of cash flow from operations. They spent 44 billion last year in CapEx. Debt payment is essentially zero. There's a little down payment here. I'm not sure I really agree with this number. That number should probably be zero. Let's just double check this. What are they paying down? So, okay, so it's slightly 4.6 billion. Free cash flow in total is going to be 60 billion. Give me 1 second. All right, 70 billion is free cash flow. Shares, 7.5 million shares outstanding. That means $9.20 of, hey, Buffett, nice to see you again. The accounting changes and big tech issues. And give me 1 second. My son's up. I got to put him back to bed. Sorry, I'll be right back. Yeah, sorry about that. Yeah, it's a very good question. The way they're you're talking about how they're depreciating their assets. They change the schedule to boost earnings. It's absolutely true. Absolutely. That's why we look at free cash flow. That's one reason why, right, EBITDA excludes depreciation. People say, oh, EBITDA is a BS metric. Agreed. EBITDA is not free cash flow. They are separate. But it also says I can't monkey with depreciation because it's excluded from the EBITDA. Meta writing down the metaverse. I don't know, man. Again, these companies make so much jack. If they spend 50 billion on a venture that fails, it's a one-time hit that's a sunk cost, and by the time they write it down, it's all over. The lesson learned, they move on. Like, I almost would want these guys taking multi-billion-dollar bets on the future to grow their business rather than sitting on the cash or just paying it as a dividend, because they're able to grow so much faster than I can. Like try to find an investment that's growing EBITDA at 19% annually. I'm sure if I stretch this back in the time, it goes back even farther, with 50% margins, zero net debt, a dominant market position. Try and find businesses like that are trading. Let's see what they're currently trading at. And tell me how much they cost. I would want those businesses to take the cash that they have and take swings. So Microsoft is trading at 16 times enterprise value, right, to EV. That seems cheap to me, given what they have done historically and potentially could do if they get this correct and these investments pan out. I don't think they would. I mean, they're not fools. If it's not working, they're going to stop it and write it down. They're not going to continue to deploy capital in these areas, year after year after year after year. Meta made a decision. They invested in 2-3 years. They changed their name, and eventually it didn't pan out. But that's only 2-3 years in what could be a decade, 2-decade long hold period. So I kind of want them taking these bets. But I got sidetracked. Let's look at free cash flow and figure out what do we want to do going forward. So if we said cash flow here in 2026 and we had some sort of CapEx estimate, what do we think CapEx needs to be annually? So this would be 2026 over here. Just like take these numbers, we'll just copy them over here. I don't want the other comments. And then, so if we said 100 billion, take some of that midpoint range. Where's our estimate? It was with 60 to, let's take 200. It's tough if it goes negative. If we could take up all the free cash flow, let's just take this 0 for a second. How do we want to do this on this underwriting? So we grow it, and then we less this divided by shares outstanding. That's $2. So here's your kind of adjusted CapEx. This is adjusted earnings, adjusted cash flow per share. If they spend 100 billion in CapEx, right? So we can take this out, and I can figure out what do we think they're going to really grow at. If it's 15, I'm just doing a different scenario off to the side so we can kind of see what this looks like, and then we can make changes if need be. So if you grow that at 15%, well, that's just this times. So $100 billion would make them negative in CapEx. I'm not sure we want to do that. Maybe we just want to make them 0 and say they might do that and then it would taper off. Not sure. I'm going to 0 it out for right now. What that's going to do is that's going to, in our IRR calculation, just look at the differential in price. So I buy it today, $389. I sell it 10 years from now for $1,400 a share. That's a 15% return, 3 to 4x return on our cash over a decade with kind of no free cash flow assumptions. You're right, they did also invest in OpenAI. I'll tell you a cool story about that in a little bit. They are trying to do an IPO. Interesting that they pulled their IPO. Didn't pull it, but they delayed it. I think they delayed it because they're seeing user drop. I think Claude is taking over, and OpenAI is not as fast, not as caught up. I know I've had issues with it just on my phone. When I talk to it, it doesn't seem to want to hold a conversation. It'll think that it's hearing something and go off on the side. So I'm wondering if the reason they delayed their IPO, this is OpenAI, is that they're seeing user growth slow down. And that probably materially affects their valuation. So this is free cash flow. Let's do this. Let's go back. I'm going to keep this the way it is, but I'm going to take these cash flows here and I'm going to 0 out, just say they invest for 5 years. You get almost nothing. You get a little free cash flow at the end, and it gives you a small boost in the IRR, maybe 2-3%. The interesting thing is this is still beating the market. Like if you think the S&P 500, yeah, I don't use it anymore either. If you think if the S&P 500 as a whole does 10% annually for any 10-year period of time, this stock here priced right now could do 50% better performance than the stock market over the next decade. So if you put a chunk of your money in Microsoft right now and you said, you know what, it's a pretty decent bet. I don't know what CapEx is going to do. I'm going to say they'll spend 100% of their free cash flow right? So I guess technically there wouldn't be enough cash there to pay the dividend, so they'd borrow some money to pay the dividend. They'd have to pay that back, but that's 6 times 6. It's $36 billion. That's a drop in the bucket for a multi-trillion-dollar business. So technically, it's not perfect, but it's swag. No free cash flow. You still get a dividend though, so it's not quite fair. But you get 17% return over the long term. I think that's pretty decent. What is the dividend yield currently? We could plug that in. Free cash flow 2.5. Dividends. I'm just never used to Finbox. I was like Microsoft or Yahoo. What's the dividend yield currently? Outstanding shares dividend. Oh, I mean it's 1%. Okay, so it's really not a tremendous amount. Maybe it's 1%. So you get, if you bought, you get $3, maybe call it $4 here, right? So that's your dividend. It's just the dividend that you're going to receive, 1% of the purchase price. Then out into the future, when you're no longer paying that capex, that free cash flow is unlocked. Hopefully, the investment has been worthwhile, and they're compounding faster than their historical IRR. And this really becomes a boom, and you get to see this. Yeah, I agree. Correct. They're not stopping the dividend. I was just trying to use an IRR calculation, and I realized we should put something in. So even if free cash flow is 0, they would still borrow to pay the dividend. So here's your dividend. Then after the investment capex kind of tails off, you get your restored free cash flow back, and you're looking at about 15 to 17% of return annually over the next decade, which is a very attractive entry point, a very attractive return. Like I said, it's beating the market by 50 to 70%. If you're buying it right now, that's the cheapest we've seen it in a decade. I went back. Let me see if I can find this. I'm going to just stop sharing screen for a second, because I remember one time we published in the Cash Flow Club 20 or 30 years of Microsoft's multiples. And I'm wondering how often it's been this cheap. So some of the analysis doesn't go, like when you go online, it's typically 10 years. I don't think we can get valuation out that far. Let me see. Of course, I'm not going to be able to find it when I want to. Yeah, I can't find it, but it was, maybe Microsoft has it. No. I think it's 16 times enterprise value EBITDA. That's the cheapest you're going to find it over a long period of time. It's a really good entry point. Let's see if I can go back 12 months. And you get a solid cash flow. And if it grows from here, I think that's a huge plus. Wow, Meta's also really cheap. Meta's 14 times. I think all these guys are getting hit. Microsoft seems the most interesting of the big tech. Yeah, the hyperscaler companies. Quite a few seem really almost circular financing. Many of them skewed growth. NVIDIA, AMD. Yeah, yeah. I'm not thrilled. Look, I'm not thrilled with them lending money to OpenAI or Claude, and Claude buying their product. You're right. I think it's kind of incestual. Um, but here, this is what I'm seeing in AI. So I think Microsoft is a very interesting play. It certainly de-risked a lot if it's at an all-time low with your enterprise value. You've got the capex problem, but I think we covered from Microsoft, if these capex problems turn out to be boondoggles and they stop the spending, they were spending their free cash. It's not like they're borrowing tremendous money and betting the farm on it. If at the end of the day it's upside down, then they just write off the asset, and the next year your cash flow spikes, reverts back up to what it historically was. The margins go back, and the investment in the multiple should return to where it was pre boondoggle. Yeah, Zuckerberg does better ripping off other people's concepts or buying his competition than he does like inventing a new game. Totally agree. Microsoft does a lot of the same stuff too, right? I mean, they kind of, I think all software companies give the software for free. They test it, they see who's using it, and then they write their own code to kind of rip off the product. That's kind of unfortunately the way that whole thing has worked. But back to AI and job losses. So this is my take. Yes, I think the software companies have been bloated and over bloated for a long, long time. I think Elon Musk proved out that he can cut 70% of the workforce of X, and X is now running better and higher ranked and performing better than it was prior to having all those people. So the rest invest, sit there, do nothing behavior of the tech world, I think, is going away. We're seeing that because interest rates have come up. It's forcing investors to have more realistic expectations about return on money, and they're a bit more prudent, and it's forcing harder decisions. So I think you're going to continue to see destaffing in the tech area because one really smart coding person can run Claude and do a lot of work. And so that goes for all of these companies. On the non-tech side, however, like in the business that I run, we're seeing phenomenal uses of AI to do a tremendous amount of work we don't have the cash flow to hire people to do. So we think of it more as less, who can I cut to do the same work? It's more of how can I teach people to use AI and have our existing staff do more with the current workforce. Punch at a higher weight. If you're a small market company, you can now perform your analytics, your marketing, your presentations, your accounting. All of that can perform at a higher kind of mid-tier company level or high-tier company level because 2 or 3 good people can do the work of 5 or 10. So you train your staff, you give them the tools, and they should be able to level up your company. That's what we're seeing across the private equity landscape, is really pushing Claude Enterprise into businesses, pushing that into reporting capabilities, analytics, presentations, and it's having a material impact. The circular finance, yes, it's happened before. It happened in the .com era, right? It's happened in, I guess, almost any sector bubble probably has some kind of circular finance where people buy off on it. The question is, how material is the cash flow or the earnings that they're getting from the circular reference? If so, you would say that there's some bit of Microsoft valuation that is the 21% of AI. So if AI is $1 trillion company, Microsoft owns $200 billion worth of value. Okay, so that's embedded in their enterprise value. but then their enterprise value has just been cut down to where earnings are now 15x. Maybe they've written off that entire value. So at some point, you're right. The circular reference does lift value, but if the stock's been hit hard enough, perhaps that the circularness has been written down to an extent where it's less of a risk, if that makes sense. Mm-hmm. I believe they are as well, just not to the level of the other hyperscalers. The valuation is also much lower than you're talking about Microsoft? Fat Fever? Maybe less while the market is already priced in and it's reflected in Meta current stock price of $5.95, so expectations are really low. Meta can easily hit. I think you're right. Meta's already flexed up that high before. I never really quite understood the whole metaverse thing, but I don't know if I understand AI, but at least I can appreciate that it has a more functional benefit than dancing in a metaverse. Can they realize earnings power for that? Perhaps. Just looking at the amount of data that our little company has been chewing up, having been running enterprise now for maybe 4 months, it's astonishing how much we continue to lean into it. So I'd imagine that capacity is going to get used for quite some time, and eventually it'll probably bust out and it's a commodity, but at the moment it seems like it's working. Tesla's interesting. I've had a love-hate relationship with Tesla for a long time. I'll tell you a funny story. So part of the lessons you learn about being a value investor is watch things that you think are overpriced continue to perform and execute and succeed, and you sit back and say, oh, they're overpriced. This is probably 15 years ago, something like that. 2012, 2015. Tesla was public. Musk had made the investment, but they were in a small building in West LA where I was working. And I remember their earnings call was going to come out, and the market was super down on Tesla. But I worked kind of down the street from their little roadster. This is when they're hand making their roadsters in a facility on Wilshire Boulevard in LA. And I would drive by this thing all the time, and I was seeing a ton of Teslas all over the place in LA. And I remember the earnings were really beating. The stock was, God, $15. I think it was $15 a share in 2015, 2012. So yeah, 10, 11 years ago. And I was like, maybe I should buy, just roll the dice, hold my breath. But I kind of like stuck to, no, you have to, always go after cash flow and do all that kind of stuff. And so I didn't buy it. I kind of sat there and said, I'm going to sit there and stay focused on, earnings and cash flow and not roll the dice. And I think a lesson for certainly young investors is to, roll the dice occasionally on companies that are potentially monopolistic, founder-led, founders that have track records of success. I think there are a lot of books out there that have been written. I know Peter Thiel's book. It's about the monopoly. I forget. I think it's called The One, where he details how he invests in monopolies. I think that's really interesting, and I probably underappreciated exactly how big those companies could be, how big the networking effect was across all of the technology stocks. And Tesla, I thought, was an automotive company. I didn't quite appreciate how much the technology was truly embedded for example, I read on X that Musk is now releasing what the X and the S so that you can build your own car and I guess turn his software on and it'll run. I'm not exactly sure, but like that stands on its face every assumption about being an automotive company. And then he's now trying to make robots, which I think that guy, if there's somebody who could do it, this dude seems to be the Midas, the Edison, the insert famous inventor's name there, but this guy seems to be that person of our generation. So it's kind of hard to bet against him. I guess the long of it is I'm interested in testing and investing in Tesla. I thought based on his track record, I kind of want to roll the dice a little bit to see if he is, if he can make the actual robots pan out. Yeah, the robo taxis are brilliant. I made videos a long time ago talking about Kathy Woods and her analysis of Tesla. And the neat thing about having a channel is you can put an opinion out there, and I left it. I haven't taken any videos down. I left it out there. I wanted to see how it performed and go back and watch it. And I crap all over it. And you go back and look at that and say, that dude really pulled it off. And if he can get the robo-taxis up and running, Kathy Woods is saying that it'll take the cost per mile from, I think, $1.20 to maybe 20 or 30 cents per traveled mile with the human out of the car. That is going to be tremendous. And I think she's right. The number of cars on the road will actually increase. And what that's going to do is it's going to make it a lot easier and cheaper for people to transport product all throughout the United States at a lower cost. So you're going to have product companies, manufacturers, farms, all kinds of people who are making more and more niche products. That's the way we're going. It used to be Coca-Cola was the one brand. You now have hundreds of different soft drink companies, right? It's becoming easier to make a brand, to run a brand. AI is going to help you even further. With cheap transportation, you're going to be able to have your own entrepreneurial whatever product company and put your product into a robotaxi and ship it to the customer. You're not going to have to go through giant warehouses or logistics chains to third-party ship product. You can go directly to your customer and have a higher bond with your customer. So I think that's really interesting with Tesla. I don't know exactly how to value that. Like, I'm kind of just trusting that Musk is gonna pull something off, because whenever I do the numbers, they don't really pan out. I think oftentimes I apply an exit multiple on a business that is too low on a tech stock. These tech stocks have maintained 30, 40x multiples for 20 years. Yeah, Charter Communications, their CapEx cycle ends in 2028, increasing free cash flow around 50%, and it's currently trading at 2 to 3 times forward cash flow. What is 2? That's it. That is very cheap. That I don't know. Like if for example, I use Starlink for internet. It's fast. It's phenomenal. That could. I think Tesla's trying to buy T-Mobile or partner with it. So if they push that out, they could replace Charter Communications with that technology. That Starlink has scaled so quickly that it's pretty amazing. Yeah, you're right. Elon can't release the Roadster. He's just got, I guess, so much stuff going on. I'm not sure. Who how many? He doesn't really have to. It's like Ferrari's business model or Rolex's business model, right? These guys are so exclusive, they will deny the average person to buy the product, and they force very wealthy people to buy multiples of the same product. It's not really a business model. And Tesla, the Roadster, it's a cool idea. I'm sure Elon is. It's a very cool concept. It gets people to click. It gets people to show up. But he's not going to sell the level of Roadsters and the market potential that the robo-taxi is. So I think it's just a focus of how much time and they have with the staff that they have. But I wanted to see what Tesla was trading at. Yeah. So here, let's look at this chart. Here, so back, it was in here someplace. 2016. Yeah, I said 15 a share. Okay, 1360. That's pretty close. And then from there, it's got a pretty decent run. 300. That's not that great. 300. So it's calculator. Maybe. Can Claude do this? What's Tesla's stock return over the last 10 years? IR. Let's see. All right, because it was 302 divided by 13. It's 23 times your money. Yeah, Tesla's PE is wild. 265. Like, I don't know how to value that stuff. Your cash flow. Some of these companies, they just like look at Uber is a great example. I never bought Uber. I always thought they were burning way too much money. Turns out they were, right? So there's a stock that in the end grew tremendously, became the name like Kleenex. So you just use the word Uber wherever you want to go. But that stock lost money for so long, they eventually had to raise rates to make any kind of free cash flow. And by the time they actually get stable in cash flow, Robotaxi could come out and completely bury Uber. So this idea that you're going to get this long stream of cash flow after they build out an enterprise, you're going to reap these dividends, and that's what the company should be based on. I'm not sure that works with these hyperscalers. Right? I just don't. It's hard. It's hard. The technology can change so quickly, and you could lose everything. What's another good example? I said this last time. The last live stream was Lovable. You guys have seen that company, the website, the AI generated company. They just raised money at a couple $100 billion valuation. They're one of the fastest companies to get to 100 million of recurring revenue. And then Claude comes out and says, oh, by the way, we can make websites. Here's an app, and completely destroys, in my opinion, the Lovable entire market. So those investors that just locked in money at whatever it was, 120 billion, like 2 days later, that thing's not worth that kind of money. So the landscape with AI is changing so quickly. It's very hard to pin down a value anywhere close to long term. Sure, anywhere close to long term. What's in your bullpen? You talking my holdings or what I'm looking at? I haven't actually looked at a lot of stocks in a while. Like I said, I was healing and kind of just took some time off. I got kind of burnt out. I still own a lot of Google. I own ASML. I own Facebook. I own ExxonMobil. I own Wells Fargo. Microsoft. Still own PayPal. Maybe they'll get bought out or they'll merge or something. I own Stanley Black & Decker. Trying to think. I own Tesla, a little bit of Tesla. Yeah, so 20x is roughly 1900%. That's the return on Tesla since they saw the original and would have bet on it. But you'd have to hold that thing for what's that, 2016 to 2029, 3 years of doing almost nothing on a stock that's losing money. That's a tough ask. I guess you could put your stock in the fact that they were growing their production capacity at that time, and that's what you're betting on. But it's hard. It's very hard to pick these growthy stocks because these numbers, to your point earlier on the earnings multiple, these multiples are just kind of all over the place. Elon Musk keep promising stuff and will underdeliver. Yeah, the dude definitely underdelivers. But you know what? He promises getting us to Mars, and he underdelivered so far. But he's blanketing the entire Earth in satellites that makes communication instantaneous all over the globe. Like, to some extent, this guy shoots so big. Even if he underperforms, the underperformance is still a game changing achievement. I mean, he's talking about putting AI capacity in space with solar capacity to run continuously on the Mars and beam it back down by laser. I've never heard anybody say that. If you can pull that off, that solves a lot of the space and energy, cooling and energy problems, if it works. Do you get into small caps, special situations? I love special situations. I like doing the finance work around it. Um, GE stock was a good one. I did it kind of privately many years ago. That's continued to go well as the turnaround. They sold off a tremendous amount of assets, focused the business. The stock continues to run, continues to do well. You still Intel? Yes, I still have Intel. I bought it. Um, Rode it all the way through the downturn. I just let it sit there, and it's kind of come up nicely. So I'm positive on that stock. I averaged down a little bit, but I got a little nervous when it got pretty low. But I'm doing all right on it right now. Yeah. Yeah. I think what I try, so working in finance, I was an analyst in investment banking for a long time, and now I'm a CFO, and we're always talking about what's the future going to happen, what scenario might happen, what do we do about this scenario or that scenario, and for the most part, um, you're building forecasts, and even when you make a budget for the year, it's extremely hard to figure out what's going to happen next year. So then you look at a business and you're saying, okay, I'm going to try to put a value on Salesforce, uh, or Tesla, or pick your growth stock, and says, okay, this thing's growing at 50% a year. It's got 24% margins. It's a subscription business. What could go wrong? I want to pay 60 years of earning ahead. I want to pay 100 years of earnings today. A lot of that never made sense to me. Um, Especially if you look at your classic companies like a Coca-Cola, a railroad company, a utility, a paint company, a multi-location retail business like Costco. I mean, any kind of these standard companies, um, that model fits. Where it does tend to break down is in this hyperscale network effect is a different way to look at the world. I'll give you a great example. I don't know how old all of you are, but if you remember classic cable television, you had lots of channels, right? But it would just play whatever they're playing on that channel. If you wanted to watch a movie, you turn it on. You might be halfway through the movie because it started at 8 o'clock. You joined at 8:30 or 9 o'clock, and you're gonna have to watch where it left off. What what I failed to realize when watching Netflix bury Blockbuster, and I sat there and watched both. Blockbuster crater and Netflix skyrocket, because I failed to understand that cable television was inherently limited because one channel could only broadcast one movie at a time. And you could have lots and lots of channels, fine, but eventually you still run out, kind of theory of, you still are depend on the clock of when movies start. What Netflix changed was the infinite storage of content, and you can call that content whenever you want. There is no clock. That changed how much content could be stored and viewed and played, and I failed to appreciate how big that was of a game changer, and how much you're willing to pay as a multiple today for what could be tremendous earnings in the future. So I think one of my largest takeaways, and I could be wrong, maybe we're all in a giant bubble, I don't really know, but is you have your traditional businesses that are much more easier to value, where cash flow is more predictable. You can look at growth rates are more steady, like a railroad business, airline business, Costco. Look at a beverage company, a multi-location retail. Those, I think, are a bit easier to predict than, say, Tesla. And if a robot is working in your yard and networked with all the other robots in the world, and you teach one robot to paint your house, and now every single robot in the network knows how to paint a house, what is that worth? I don't know, but I'd love a robot to come out, help me in my yard work, and paint the house. So it's so hard to value that. You kind of just toss money at it. I'm not condoning that, but I think that's the difference between classic value and this. I mean, Benjamin Graham never had access to businesses that could scale globally at the rate that they're scaling now. No way. So I think it just takes a little bit of a different lens to look at it. That might not fit in the easiest of lens when you're looking at kind of a value business. What do I think about the PayPal acquisition? We'll see. Acquisitions are tough to get through. If they can, if they can consummate it, I'll probably continue holding the consolidated business. Copart's an interesting company. I think they're down, aren't they? Right? So models. Let's see what these guys have. They've got an EBITDA 5-year EBITDA model. Let's see what this looks like. So they're saying revenue 4.6 billion. Billion? Yeah, well, it's bigger than I thought. Growth is kind of low single digits. Margins are 40%. Margins are very strong. No margin growth. Mid-single digit earnings growth. Where's the terminal value? Terminal 14 times earnings seems reasonable for a single digit enterprise value business. I wouldn't pay much more from that. What's EBITDA been historically? Youch. 25 times. Paying 25 times for a single digit growing earnings company is too rich. Paying 12 times seems much more fair, much de-risked, and a little cheap. I would not expect this business to go back to 25 times. I think you're 15, 18, bumping along. If you get a good dividend, it's a decent business. I like the business itself, servicing cars and car parts. Great business. We're going to have lots of used cars for a long, long time. But I would not expect that to go back to 25 times. What do I think about Berkshire Hathaway? It's a great stock, man. That thing keeps just plugging away. Um, it depends what you're looking to do. That as they get bigger and bigger, there it's going to be harder and harder for them to beat the S&P 500. Just deploying the 150 billion in cash they have is going to be just a smaller set of companies for that they could deploy that money to. So it depends on what kind of investor you are, how young you are, how much runway you have. If you're midlife and you want to put some money away for some steady growth that's conservative, great, go for it. If you're in your 20s and 30s, you might want to look at other stocks, or you can still do it, but keep a limited amount. Don't put everything there because it's going to grow a little weaker than some of these other businesses. So it depends on your time horizon. Yeah, I know. Watching Intel drop to 19 and saying, "Oh, I know, I'll just double down." It's very easy to say average down, but it takes a lot of stones to do it, man. I couldn't do that much. I put a little bit more in it. I said, "Well, I'm just gonna ride it out and see what happens." What are those stocks do I recommend for young people? It's an interesting comment. Um, Trying to think of books to read to show. Um, I think looking at businesses that are run by founders, from what I've seen, do better than you would think. Um, so I don't know off top of the hand which ones I would buy, but I do think having a bit more tech, a bit more software um, exposure is probably a good thing. Um, yeah, I don't know any names off the top of my head yet, but if I get to it, I'll let you know. Greg Abel, I think that we'll see how he performs. I don't think he did that well with the earnings call on Berkshire, but um, it's his own style. Buffett hires kind of, don't take this disrespectfully, but like folksy kind of Midwest guys, which whom I love, and I'm kind of, it's probably the wrong word to use, but salt of the earth kind of people, and we'll see how he performs. Um, Certainly bright enough to run the company. Just doesn't have like Buffett's just such a unique person. How do you replace that? It's impossible. Do you have any advice for pivoting into finance M&A from cost accounting? Do you recommend the CFA? Yeah, I like the CFA a lot. It helped me understand what I lacked from, like, I majored in finance and economics, and I got out and I couldn't really run a financial model, or felt like I could value things the way I wanted to. So I pursued the CFA degree or program, and worked really hard to weasel my way into jobs that would let me pivot. But it's very hard if you're not if you don't go into undergraduate and fall into the banking programs to do the standard investment banking track and come out of that. It's very hard to break in. You really are going to have to humble yourself and go find, you're gonna have to hustle to get into a job that you want, and it's probably going to be a pay cut to do so. um, I'll give you one example. I got a list of 45 private equity companies in a city, and I emailed all 45 of them coldly, asking for an unpaid internship that I would do whatever they wanted. I just wanted to learn. And and I had two that actually responded that were willing to meet with me, and one gave me a job. It was an unpaid internship that I took, and I did that for 6 months. I was trying to work a normal job and then go there and work part-time. It was very um, haphazard. I was not there as much as I would have liked to have been because I was just trying to make money to live. But what I did learn and what the connections I made got me my first paid analyst role, and that worked from there. So if you're looking to break into finance, you kind of have to do something like that if you didn't go the traditional route of, like a Merrill or Morgan Stanley analyst program route. But it works. There are lots of groups out there. They need help. Find an industry. If you can find an industry that you really like, go for a bank that works in an industry and see what you can weasel, sell yourself. That's kind of the whole name of the game. Yeah, Lululemon is beat down pretty hard. Let's take a look at this. I mean, that thing looked cheap a while ago, and I have to say that has just had nothing but bad news. Um, this stock is just, I mean, let's see. Models. Let's do an EBITDA model. What's it trading at currently? $117. This is saying fair value's 260. So there's a doubling there someplace. Who knows? You've got revenue, single digit revenue growth potentially. It's down this year. They've got to be able to figure out how to grow revenue. Margin at 25%. Let's see the exit value. Exit value at the multiple is 8x. Like that is a terribly cheap forward multiple. Now some of the other clothing companies like Ralph Lauren and others trade at low ranges too. So this is not out of the ordinary. But if these multiples are producing implied fair values of 200 to 250, I think that's very cheap. I would hope that some private equity company would put a bid in and try to take this thing private, because it needs to come out of the market, retool itself, fix margins, get growth back, and then re-IPO. And your classic like KKR kind of Leonard Green Partners, big, Gore's group, kind of big group. Look at that downturn. Oof. Oof. Enterprise EV 5x. Look at this multiple collapse from 40 times, 40x earnings down to 5.5. You want to talk about market multiple compression. Even if earnings don't move, just that multiple compression on its own is just cratering the stock price. I heard that Buffett does not like buying consumer-facing companies. I didn't hear it. Charlie Munger said it, but now that I think about it, Coca-Cola is a massive consumer brand, and so is American Express. I'm not sure if that's accurate or not, but maybe he doesn't like it because customers can be fickle. What is in fashion one day with Lulu can come out of fashion, and the market multiple can crater. So if you can't control this, you can control your earnings to some extent. You can kind of get into markets, right value, all that stuff. But this market multiple, this is the popularity contest versus a weighing machine that Buffett would really talk about. Thanks, guys. Thanks for watching. I appreciate the time. Our company is a Chinese sourced LLM model. I don't know. I don't know. It's a very interesting question. I mean, wasn't there something like Zoom, or there was some video conference, maybe someone knows this, that they were routing the data feed through some other country. I want to say it was in Africa, and that is where the data and the conversations were all being stored, and then it was piped back in for some sort of analysis, something like that. So maybe where we think our data is living, maybe it's not always where we think it is. Nike's a tough story. Like, those guys, that new CEO came in and really destroyed a lot of value. His arrogance, I think, said, hey, we're going to take our business from the brick and mortar and go directly to consumer, and not realizing how dependent they were on Foot Lockers and the retail world. Not only dependent on those, but then also by not filling the shelves of Foot Locker, it opened up space that Foot Locker needed to fill, and allowed companies like OnCloud and Hoka and others to put their shoes on the shelves of Foot Locker. And then those sales guys sold those. They sold what they want, commissions. So they're going to sell whatever's in the room. And that helped their competition get a foothold. A very interesting kind of study of how you can destroy a lot of value from what was a very good company for a long time. 13 times market multiple. This thing, again, was as high as 40x, but lived north of 20 for 23 for a long time, and now it's at 13. That seems very cheap. What is what's the free cash flow on this? Are they making much money? They have a free cash flow yield, 3.5% free cash flow yield. That's pretty high for the company. Not like crazy high. Let's see what they earned last year in cash flow. They probably took a hit. Fiscal year, 2.8 billion of operating. Oh my God, look at this. Down from 7.4 billion in 2024 to 2.8 billion. So they're getting absolutely hit. They're pulling back CapEx. They're still on a hook for dividend, and they're growing their dividend. Let's go back in further time. So they're not. Look at that. Their dividend continues to grow. This is Nike. Operating cash flow is down pretty significantly. So it peaked in, 2024. Hopefully they've bottomed, but I mean, maybe not. So they make operating cash flow 2.8, CapEx 7. So that makes it's like 2.1 of net cash flow. Then they pay a dividend of 2.4. So they have we're talking a couple $100 million left after cash flow from operations, CapEx, which has been shrunk, and dividend. They have almost no free cash flow to do anything else with. Next step is to borrow money, cut the dividend, issue shares. They won't do that, but borrow money or cut the dividend. None of those are good options. Yeah, Nike's got to get its mojo back. I don't know how they do that, but they've got a lot of competition. They lost a lot of foot traffic. Interestingly, though, revenue itself isn't really down. They had 1 year of revenue. I bet you a lot of this is price increase. Let's see. Break down Nike's revenue growth over the past 5 years. Was it unit or price per unit change driving the revenue? I would guess it's price of the shoe. But let's see what the good old Claude has to say. So I think the AI play. Maybe I don't know how to play this yet, but I think the AI play is really going to allow um, some of these labor intensive companies or just other companies that require a lot of headcount or labor to scale to be much more effective with their personnel. And so maybe these small cap companies, mid caps will start picking the growth up a little bit more because they can use AI. They don't need to employ as many people, or as they grow, they just don't hire, and they're able to expand margins more and more. So as margins grow, if you've got steady um, market multiples, the enterprise value should grow nicely for some of these companies. I think that's what the economy is really feeling right now. All right. Claude is doing its thing. It's taking its sweet time though. Any other questions, guys? Otherwise, what time is it? It's getting late. No, I don't follow any European stocks. I guess I take that back. I know a few, like SAP. Um, payroll is a very interesting thing. Payroll is one of those things that is so sticky because you never want to mess it up. It's one of the last things that companies change, like their accounting system. If they're on Dynamics or Sage or Oracle or NetSuite, you just don't change it. It's too much risk to change. The same thing for SAP. Um, I've changed accounting systems, I've changed payrolls, and it is always a major pain with big risk of not making payroll, not paying your employees, messing up the I-9 the tax returns for people. They're having W-2s issued twice. It's a major issue, and so as a result, the revenue in SAP and those companies is very sticky. However, I think with AI, it's going to make it easier to stand up other payroll models. So while SAP might not lose customers quickly, I don't think they'll gain as many going forward. That other ways to run payroll will limit growth for that business. While Coca-Cola's growth has really fallen off. Last year, 1.9%. That's below inflation. Prior year, 2.9%. That was below inflation. In 2023, 6.4. I think that was below inflation. Wasn't inflation didn't spike in 2023? When was it 9%? In which case, Coca-Cola's real revenue has fallen behind. How about operating profit? Hey, it's up. They got a nice little pop. Okay. They've been able to move that higher, certainly recently. Where did that come from? It's not revenue growth. It's not gross profit margin, 61, 61. Sales and marketing, I don't know what other is, but they saved. I hate giant buckets like this. They saved 3 billion there. That 3 billion passed through to operating income. So their profitability came from some sort of cost cutting here. Whatever was listed in other income and expenses. Oh, Nike's back. So let's see. What do they say? 2021 total revenue year over year growth 19%. Footwear units down 5%. Price up. There you go. Here, can you guys see this? I don't know how to make this bigger. I'll just read it out for you. So this was again reminding you of the breakdown of Nike. If they're growing revenue, is it units or price increase? So 2021 units down 5%, price up 13%. 2022 units down 4%. That's 2 years in a row. Price up 9%. 2023 unit volume up 13%. Price up again 7%. 2024 units down 2%. 2025 units down 8%. 2026 units down 1%. And now price is actually coming down. So price fell 2% and now price fell 1% last year. They've got a problem. They were masking unit volume problems. So when you have a problem in the business, you're missing your your revenue forecast on units. You automatically go to price. You always say, how can I get the existing customer to pay a little bit more? And they raised pricing. And then it happened, instead of taking that as like, hey, there's a test here. We raised pricing 13% in 2021, and in 2022 volume fell again. So they made the mistake of raising pricing a third. In fact, they raise it every year, 4 or 5 times in a row. And unit volumes continue to fall. Only after 6 declines in the last 5 years do they start actually dropping price 2% or 1%. They're in a problem. They are way overpriced for the shoe, and I think the customers they might not ever come back. I mean, they have a real problem. Nike does. Oracle's debt rating. Doesn't Oracle have a ton of debt? Overview. Quick test. How do you tell if a company has lots of debt quickly? You look at enterprise value, look at market cap, and you look at the difference between the two will be your debt. What's ORCL? Debt net cash. Statistics. So current enterprise value of 460 billion, market cap 360. You have 130 billion in debt. What do they earn? EBITDA is 30 billion. That's 4 times leverage. Okay, that's on the high end side. I don't know what their debt rating is or what their cost of debt is, but 4x debt is fully leveraged. That's something I wish they should pay down, de-risk the business. Although look at the enterprise value, EBITDA has come down tremendously, 13. The one thing I do like about this business is that Larry Ellison sits on the board of Tesla, and I think being around Musk, he's learned some aspects of how to run software businesses, and maybe that's going to help him boost earnings. I thought that his EBITDA was growing. Let me see. Let's look at their financials. Yeah, so the question is, how did, I hate reading questions like this just because I'm trying to flatter myself. How did you develop your business insight? The Nike breakdown, price versus unit volume. I never would have thought of that. Was that just repetition or reading, doing? It's doing. When you build a forecast for a business, certainly a product company or even a service company, you're gonna have four things that I always focus when I build revenue. In any forecast model, I've got existing customers, the number of existing customers that are kind of come through, and their average sale price. You can dive deeper into like product mix, average price per unit. You can get even deeper, but at the highest level, brand new customers, the number of customers, in this case, products, number of shoes, but you can do one shoe, one customer, and average sale price. So if you have one customer who buys two shoes, it's twice the value, whatever. And then you have your new customers, the customers never seen you before, and their average sale price. Combine all four of those by multiplying, add, you get total revenue. So if you're missing in a revenue, it's got to be one of those four components. Your existing customers are going away. They're not coming back as frequently as you think. Generally, there's a pool of customers there you can measure, like email lists, your CRM leads. There's lots of ways to measure existing customers. And then their average sale price, or your new customers. You're just not getting your new lead. Your leads aren't converting to new customers at the rate you once were. That's a marketing problem. That's a funnel flow problem. Or the ASP, your average sale price, between either of those is different. So those are the four levers you quickly go to figure out what's wrong with revenue. For product company, service subscription models are a little different. You've got churn, you've got replacement rate, and your churn volume. Where we Oracle, revenue was growing 17% last year. This is the growth rate of Oracle's revenue. I'd have forgot when Larry Ellison got on the board of Tesla. When was Larry Ellison on the board of Tesla? And so, like, the growth rate has picked up on this business, and I'm wondering if he's kind of gleaming ideas on how to run a software company better, because he's up there in years, and he might need to pivot a little bit. Gross profit, operating. Here's your operating, and look at the spike in operating income. That the last 5 years have had a nice upward momentum. Let's see, Larry Ellison served in the Tesla board from 2018 to 2022. He's gone. That was when did he stand re-election? When he did not stand for re-election in the annual meeting. His appointment came as part of the SEC following Musk's funding secured tweet, which required Tesla to add independent board oversight. Interesting. So he was out. So he was in 18. That's long enough to learn. So 18, he showed up. And then let's go back to the growth rate. 18 would be here. So he's growing at 4.2%, hangs around, turns the bit. It doesn't really line up. Okay, I thought it would line up a bit better. Never mind. Either way, something's changed, and they're now doing double-digit, kind of averaging double-digit growth the last 5 years top line revenue. Gross profit software is 70%. That's surprising. R&D has been growing. It's probably growing as a percent of revenue. So that probably fixed. Sales and marketing is flat. They're really not spending much more on sales and marketing, so you're getting margin there. Admin expenses the same. That's not growing at the same rate revenue is. So I would expect operating margin to be expanding. Profitability, there you go. Your margins are growing. Margins are growing because top line's growing at double digits. Gross profits flat for these years, down last year. But then the rest of this bulk operating expenses roughly fixed, 23 billion, 20 billion. So you've got margin growth. Great job. Let's look at share count. Weighted average diluted shares outstanding, 27, 28. So they're growing ever so slightly. but it's basically flat. So that's true earnings per share growth. Let's see what kind of cash flow they're making. So cash flow, $31.2 billion in cash flow from operations last year. Wow, it's doubled in only 2-3 years. It's up 3 times. It's since the bottom of 22. Oh, but look at the capex. Oh God. There's your capex problem you guys are talking about. 55 billion in capex investment on 32 billion of cash flow. That's why they're heavily leveraged. They are so okay. This is the difference between Google and Oracle. One difference, just how they choose to finance the growth. Larry Ellison is clearly a risk taker. He is betting much faster on, and it could be he's playing catch up. I don't know, but he's willing to bet more on capex than his cash flow from operation relative to Google, which was saying, hey, I'm going to spend kind of a little less than my cash flow from operation, so I'll just pay cash. Larry Ellison saying, no, I'm going to borrow money, spend all the cash I generate, plus borrowing money to go build this thing out in just a bigger gamble. You can see that reflected in his balance sheet here. So long-term debt went from zero, he was debt-free 2 years ago, to 46 billion in debt in the last 2 years. That is causing him to have to lever his business up. He's buying back less stock. So he was buying 36 billion, 19, 20 billion stock, 17, and now 2. And last year, essentially 0. So he said, I'm no longer buying stock back. It doesn't pay a dividend, but I'm going to take that money and I'm going to focus all of it into this growth. Plus, I'm going to borrow money to hopefully grow even faster. And interestingly, you are seeing that in top line. So you have to give him credit. He shifted from stock buyback, and you can see it right here. He shifted from buying back stock right here. Here's a graph for you so it's easier to see on this channel. The blue bar negative means it's cash out that he's buying back stock. He reduced that, and then you look at capex, you kind of get the inverse of that. Boom. So he stored up some cash, got his ducks in a row, but he was planning to do something, and now he's going after it. So and then you go to revenue and you say, okay, what does revenue look like? Revenue's tipping up as it appears. This is some assumptions on my part. Do your research. It appears that his capex investments are starting to yield more revenue and higher profits. That could be very good for the business long term. Let's go back to the market multiple, valuation, EBITDA. He's at 16x. Okay, this business is not traded high at all. I mean, we're talking 12, 10 times for a long, long time. Got a little crazy there at 20, 30x. But 15x for a business, I mean, it's leveraged, so it's fully leveraged. But if he can continue to grow at those margins, he'll do quite well. Best regards from France. Thank you. And Germany. Appreciate that, guys. Yeah, thanks for hanging out with me. Appreciate the time. Thanks, Vet Fever. Appreciate that. Yeah, Buffett does. He's starting to talk about Google, but it's not his thing. He as I've seen this happen in my own life, and you can look at it if you go back to the channel. I talked about this at the start of the outset of this whole podcast of this live stream. It's like you have to pick a few industries that you know really well, and you read those and focus those. That's what Buffett has always done, and he just waits for a deal to come in his wheelhouse, um, he always equates it to the strikes, right? I forget who the big batter was that he brings up, Ty Cobb or one of the old greats, but he shows the strike zone. It's really big, right? It fits like 32 strike balls in that strike zone, but really your biggest batting average is only like right here. It's like 2 or 3 or 6 positions of the 32 in the strike zone. So Buffett just waits for one, and you think of each one of those balls being an industry that he reads. So he just reads everything he can on, call it a dozen industries, and he waits for a really good deal in one of those industries where he knows what to do, and then he feels very comfortable. And what he doesn't do or has never done is read up on software businesses. And me as well, my background is mostly service businesses. It's also brick and mortar retail and running those companies. So I think I can look at a business that has more tangible track record on it than a software company. It's harder for me to estimate where a software business is going to go. That was my earlier comment about understanding the value of the network effect on some of these hyperscalers. UK, all right, got all kinds of people. Cash Flow Club is in the house. Great to see that, guys. Thank you. Yeah, so the best advice I can give you is pick a few industries that you're naturally passionate about, or maybe you have a little bit of expertise in already. It doesn't take a lot to kind of beat the average. You just have to be super focused on it and be willing to bet. And that's why if you read a lot in one industry, a good deal will be served up to you, and you can hit that one and do it well. I happen to be looking at Facebook for quite some time, reading the report and looking. I was working at an e-commerce company. We were doing digital marketing at the time, and I realized how these guys were buying customers through Facebook marketing. This was 10 years ago or so, so still Facebook hadn't changed their algorithm yet, and I was realizing just exactly how much control you had over how you acquired companies in Facebook and how to do that effectively. And that led me to kind of better understand Facebook's value proposition and got me comfortable with their higher multiple. And I remember when Zuckerberg was brought in front of Congress, everybody was freaking out. The stock went down, and I bet pretty big. I went to the bank and got a personal loan, and I borrowed money on that stock because I had been watching it and reading it and looking at margins and studying it for so long. When it was a third of the value or whatever it was, I realized this is a huge buy, and that's when you can step in with, hopefully, I'm still nervous about it, but hopefully enough comfort to do it. And hopefully you can win. And that's how a lot of the big fund managers, the active managers, they bet big on industries that they believe they know well, and it can work very nicely. But you can't get distracted by the shiny ball when someone's talking about space stocks. You're like, oh, I'm gonna go run in this direction, and you have no understanding of what it could be. You got to play in your lane, or spend a couple years reading up on that space, the area before you go diving into it. And that's what's difficult. It's doing nothing, which is the most challenging aspect of investing. Yeah, I mean, worked in oil refinery. Yeah, that's a great. I mean, that's a great experience of knowing what like the crack spread is, or what the oil basin is doing here or there, or what the margins look like. Like certainly when you could buy future crude for less than current price for like that month or so, that front month contract with negative, and people were talking the Exxon and Chevron were going to have to merge. I mean, that was just crazy talk. And you had all the ESG comments, and they were charging more for coal companies and more for oil companies because everyone's going green, and that whole thing got overplayed. And I kind of went large in Exxon at that point, and did quite well. But you don't have to make a ton. You just got to know, hey, oil demand globally has gone up every single year since what, eternity? With very few exceptions. Even recently, it's still going up. And here they're talking about it going out of business. It's crazy talk. So you just kind of big macro picture like that, a big movement. Pick a leading horse and just go with it. Yeah, fair. Upstream and downstream, agreed. Look, there's tons of nuance in there that I don't claim to fully understand. I was just trying to get, who's a dominant player, who owns some of the assets, and if their price multiple's been cut in a third, maybe it's overblown. Yeah, for industries, if you want to learn industries, you should go to some of the large investment banks online. Obviously, they have analysts that will publish white papers on industries. And instead of reading the 10K, you can search for, or go to Claude and have Claude pull up, hey, find me, market analyst reports from major investment bank institutions that detail the, I don't know, oil industry, and it will pull up, hey, Credit Suisse follows the top oil companies and their key analysts are X, Y, and Z. Here's their name and number, and you can call these guys. They pick up the phone. I was taking a job a long time ago at a public company, and it was kind of a sketchy public startup-ish company, and I didn't really know how to think about the business, and they had negative cash flow at the time. And I saw that a couple analysts were following them. One of them was a CFA, so I called him and said, "Hey, I'm a CFA. I'm thinking of taking this job at this company. What do you think?" And he gave me his research report and talked to me about the company. These guys pick up the phone. They're just like any other desk worker. You call them, they might say something. So if you're interested in an industry and you want someplace to start, go to the analyst route. Go to the houses, see if you can get their papers. There's a lot of stuff that they publish for free. And then read those and get their take on where to start with your research. The 10K is specifically for the business, and don't forget the 10K is through the lens of the CEO, who has a vested interest in you liking and looking favorable upon his company, right? Because he's a stock owner. He wants you to buy in. So go to the independent bodies, look for giant macro trends. If you can find giant defensible macro trends, then go into the 10Ks and see how well a company is performing relative to the macro landscape. Just for example, I was looking at Coca-Cola, right? It's just showing you revenue for Coca-Cola was growing less than inflation over the last several years. That's not a good thing. If you look at the beverage industry as a whole, it's probably growing if you include like soda waters in that. Okay, so if it's growing and Coca-Cola is underperforming, that's not a great thing long term for a business. So I think that kind of benchmarking work is a lot of what Buffett does, and then from there he tries to pick a top performing horse that's within the industry. All right. Any other? Let's see. Try to think of any other tricks or interesting things we covered using Claude. Let's see. Anything else you guys want to see? It's on, what do we want to see? What's a good company to look at? Disney is the only company that can come to mind. Let's see if we can pull it up. Disney's kind of in a league of its own. Not the best stock to pick. Seeking Alpha, Yahoo Financing, Fidelity, Schwab, Merrill Lynch give retail clients access. Morningstar, okay, but who has full sell side coverage? J.P. Morgan, Goldman, Wells Fargo, but licensing runs 5-year figure. Are there any public research reports from the sell side? Thanks. Let's see if this works. It'd be nice if you can just get Claude to get you some of the reports. Home building's a good one. Home Depot is another very interesting company. It continues to do well. Let's see how they're doing recently. I don't know about the home builders though. I don't know if I think Buffett picked up a bunch of them. We are kind of in a housing shortage. We do need to build housing, so I guess there's always going to be macro demands for that business. Okay, so this is kind of saying if you have an account with some of these, source, free sell-side research guide, Morgan Stanley's self-directed guide, NerdWallet, Clark Square Capital. Yeah, so this is saying for research reports, go to your brokerage house, your trader. If you're at Schwab or Merrill, maybe you have access to the research reports through those houses, through your brokerage firm for research when you're starting to look at a new sector. So Home Depot growing top line recently, 3-4%, -3-4. So right above inflation. Like inflation's 3% right now. So we're at 3.2 last year, 4.5, -3 in 04. That's not good. And then they had massive growth in 21 and 22. That was kind of the COVID era build out. So pretty flat. Operating earnings are kind of flat. I don't know if people are maybe buying a little less. EBITDA recently has flattened out. So diluted shares, they're continuing to buy back shares, and that's propping up earnings per share growth is probably to come back as well. So maybe they're not the best. They're not the best pick. There's one company. Some of the other companies I'm coming to mind were what was that veterinary company I did a while? Zoetis. These are drug makers for animals, right? Everyone spends money in the vet business for their dogs or cats, cash pay business, some insurance. But these guys make the drugs and so forth that go into the animals. Top line revenue growth is strong, profits growing. I think recently their market multiple has come back. Like look at the price drop here. It's come down in the 70s. It was 180, 170. You can now buy this at less than 10 times enterprise value EBITDA. Seems like a good deal to me. This thing is for a long time has traded north of 20x. You can now buy it sub 10x. There's a lot of de-risking here that's happened for what is essentially a pharmaceutical company. in the vet space. So I don't think you have like the headline risk with healthcare and whatever JFK Jr. is going to do to what Medicare, Medicaid. None of that stuff applies because it's cash pay vets. So pretty interesting. Free cash flow yield, 7% free cash flow yield. That's a healthy, chunky number for a company. Let's check leverage. Net debt to EBITDA less than 2. So this thing is checking a lot of boxes. Like on a quick smell check, might want to take a look at this. Return to common stock equity historically, wow, 67%. Return on capital, 24%. It's a neat little business. I might have to look at. I've looked at this business for a long time. I might have to actually buy that stock. Interesting. Let's see. What else is interesting? Thanks again for the level of detail you provide. Questions. There's always something you continue to improve. I appreciate that, Favor. What about Nintendo? Yeah, Nintendo's an interesting one. I looked at it a long time ago. I converted everything from yen to dollars. I thought it was an interesting investment. I haven't looked at it in a long time, and if it's not already in dollars, it'd be hard to do. This is the pink sheet stock. Is it in USD? Yeah, it's in USD. Continuing to climb a little bit. Continues to kind of eke out. 15 times free cash flow. Net debt is 0. Like the Japanese run tight ships, man. Got a lot of cash, no debt, continues to grow. Just doesn't get the pizzazz as like some of the other stocks. So I think this big multiple was when they were releasing a new console system. I'm not sure if it did as well as they thought it was going to do. I'm trying to think if there's anything else that I've come across that I thought was interesting. Do I don't even have a paper right here. Someone, I was trying to think if there's anything else. That's all I got, guys. I think I'm going to sign off. Thanks everybody for watching. It was a nice episode. I'll keep kind of posting and just doing some live streams. Come with questions. We'll just chat and kind of go through all kinds of stuff. Lesson learned, value investing, what things look interesting now. Maybe who knows what happens. We can talk about the economy or look at economic figures if you want to go down that path. But keep cranking away investing. Keep tucking money away. Don't touch your portfolio. The best thing you can do is just forget it. If you want to make an investment, go earn more money and put the new money into the stocks. Selling and trading, I think it's a lot of work in the end. Put your money with phenomenal managers. Let them go do their thing. Let them toil every day to try to improve revenue and earnings power, and they're working for you. Go earn more money and then put more money to work. I appreciate the time too. Thank you for tuning in. Look at Starbucks. I haven't looked at that in a while. And Estee Lauder is the last one I'll look at. Starbucks growth. These guys just aren't doing much. And I heard they were going to sell their Chinese division to what was the Chinese Starbucks coffee ripoff company? Luckin Coffee? Does that sound familiar? Yeah, Starbucks just isn't doing much, man. What's the price? 103. I wouldn't look at this stock until it's in the 70s. And Estee Lauder. I think it's just EL, right? Yeah. I always misspell Estee, E-S-T-E-E. Estee Lauder, 83. Decent price. Oof. Not good. These guys are all the kind of private equity play of buying startup cosmetic brands and rolling them into their platform and distribution network. So if you think of like, well, I don't like that makeup brand. Well, they own 50 brands. Like anything that's out there, they're gonna own. Here's their collection. I don't know half these guys, so bear with me. I'm just an analyst looking at a business. But I mean, Joe Malone, Tom Ford, I don't know half this stuff. Estee Lauder, Clinique, Mac, Bobby Brown, Too Faced. So Smashbox. Some of these things are more popular, trendy, but the concept is, hey, I've got giant installed manufacturing capacity. I go buy this startup makeup brand that's doing well online, take my manufacturing cost, push it through their brand, and expand margins. And if you buy them, right, and you can grow them with your distribution network, then you can unlock a tremendous amount of value by growing the brand. Same thing that Coca-Cola does by buying, Poppy or some of these other drink companies and run them through their marketing and distribution chain. Pretty interesting. But the stock's been beat up recently. I just think it was interesting. If it gets back to, it used to trade kind of north of 20. Now it's a little cheaper. Kind of a fun little thing. But I digress. Thanks everybody for the time. Thanks for logging in. We'll catch you next week, or in a little while we'll log back in. We'll do it again. All right, everybody. Have a wonderful evening. Take care.